everyone. Thanks so much for joining. My name is Denise Loria. I'm the Special Projects and Operations Manager here at AFC. We have an awesome webinar lined up for you guys. We're going to be talking about what's next in state AG litigation. This webinar is in collaboration with our great legal advisory member, Arnold Porter. We are offering CLE credit for this. So about an hour ago, I sent an email with the CLE request form and the materials. We'll also be sending a follow-up email at the conclusion of the webinar as well with additional information. If anyone ever has any questions throughout the presentation, feel free to drop them in the chat or the Q&A feature. We'll hopefully get to them. If not, I'll include my email in the chat and you're more than welcome to forward it along to me. The webinar will be recorded. In the event that you have to hop, we will be posting it on the AFC website and including it in our weekly wrap that goes out tomorrow afternoon. So without further ado, I'm going to pass it over to Meredith at Arnold Porter to kick off our conversation. Enjoy, guys.
Thank you so much, Denise, and welcome everyone to our state enforcement webinar. I'm just delighted to be joined by such distinguished panelists today. We're going to be talking a little bit about the this perception that the federal government has decreased enforcement of some consumer financial protection laws and states are stepping up to fill the gaps. We want to ask questions like, is it really true that the feds have vacated the field? And what have we learned in the last 18 months of the new administration about the priorities of both states and federal enforcement attorneys? And how do fintechs and their service providers navigate this landscape as it's shifting? I'm going to let each of our panelists introduce themselves. I'm going to call on them in alphabetical order, so not in any other order. I'm just so delighted to be joined by all four of them today. Denise mentioned it, but for those who are seeking CLE, I will read an attendance verification code during today's program, probably towards the end. You'll need to provide that code on the affirmation form that you should have received earlier. So please, Dan, if you could start us off by introducing yourself.
Thanks, Meredith. Hi, everyone. Dan Chang, General Counsel, Chief Compliance Officer for Thread Bank. Thrilled to be here. Hopefully I can add some insight to the conversation.
Thanks, Dan. And then we have Michael Johnson from one of my partners here at Arnold Porter.
Hi, thanks, Meredith. It's great to meet everyone. I'm Michael Johnson. I am a partner in the Washington, D.C. office of Arnold Porter. We call that the mothership affectionately. I have been litigating in the financial institution space for nearly 30 years now. And so I'm excited to share what I know a little bit today. I'm excited. Thanks. Look forward to it.
Thanks, Mike. Becca?
Hi, everyone. I'm Becca Cronland, Deputy General Counsel at Pathward. I oversee our attorney teams who partner with our business units across the company. So I'm really glad to be here today and look forward to the discussion.
Thank you, Becca. And last but not least, we have Claudia.
Hi, everyone, and thank you, Meredith. I am Claudia Quiros. I was appointed by Governor Newsom as a general counsel for the California Department of Financial Protection of Innovation in November of last year. And the FPI, as we also call it, is the financial regulator in California. I joined the department in December. And while I am newish to the department, I'm not new to public service. I spent 11 years as a federal prosecutor, starting as an assistant U.S. attorney in the Northern District of California, and more recently as Deputy Chief of the Department of Justice's Computer Crime and Intellectual Property section in Washington, D.C. So thanks for having me.
Thank you so much, everyone, for joining us to talk about this important topic. So I wanted to have the slides now, Denise, if we could start. And we can skip, I think, the first slide and get straight into our discussion of federal preemption. One of the things that we've seen in the past year is federal agencies stepping up aggressively to assert federal preemption. We have a couple of examples of this new wave of federal preemption. And what I wanted to ask folks is how how is it impacting state enforcement of their financial services laws? For instance, we have the OCC's guidance on states' interest on escrow laws, and I think, and then we also have the OCC's interim final rules on preempting the Illinois Interchange Fee Prohibition Act. Claudia, can you talk a little bit, just to kick us off, about how states are responding to these types of federal preemption efforts?
Sure. And so you point to two specific OCC actions. But before digging into those two examples, it's important to frame like how they fit into the overarching trend occurring at the federal level. We are witnessing a deliberate multi-agency push to expand federal preemption of state consumer financial protection laws, and California is squarely in the crosshairs of that. The OCC has been candid about its agenda. It has described federal preemption as a critical tool for reducing unnecessary burden, enabling local and national prosperity, and unleashing economic growth. So while interest and escrow preemption and interchange fee bans are just two examples, they are part of a bigger shift that we're seeing, and I think we're likely to see more examples like this. So starting with interest on escrow, I know you have a brief description on your slides, but for folks who are not familiar with it, just a brief background. In late December, the OCC issued two proposed rules to essentially preempt laws in 12 states, including California, requiring mortgage servicers to pay interest on consumer escrow accounts. If finalized, the effect would be that these rules would exempt national banks from paying interest to homeowners and funds held for taxes and insurance. In response to this, several states submitted comment letters in opposition, requesting withdrawal of the proposed rule. California DFPI submitted an individual letter. New York AG's office also submitted a letter opposing both rules. We, California, signed on to the New York letter, as did California AG Rob Bonta and attorneys generals and financial regulators from several other states, notably including some beyond the 12 that were specifically impacted. Why did we oppose and other states oppose these rules? So first, the OCC's proposed interest and escrow determination in our view, is inconsistent with the National Bank Act and numerous federal circuit court decisions governing preemption of state consumer protection laws. Another reason we oppose is because the proposals effectively strip states of the right to protect consumers and regulate business conduct within their own borders. And third, this will result in direct harm to homeowners. So borrowers in affected states would lose interest income on their own money held by a national bank. This has the impact of affecting millions of Californians, including people who are still recovering from last year's wildfires in Los Angeles. And it would also create an inconsistent treatment because a constituent's right to earn interest would depend entirely on who services the loans. And many times consumers don't get to choose who services their own mortgage. And lastly, in addition to undermining housing affordability, the proposals would create a competitive disadvantage for state-chartered banks and non-bank servicers who have to continue paying interest under the law. And I'll just briefly, the Illinois fee swipe ban. So last week, the OCC issued an interim final rule that would preempt an Illinois state law. That's the Illinois Interchange Fee Prohibition Act, which is actually set to take effect on July 1st, barring credit card operators from collecting interchange fees or swipe fees on taxes and tips. Preemption is effective at the end of June, June 30th. And currently there's litigation on this law. It's being challenged in court by various financial trade groups, institutions who have sued to block the law. Because the case is currently on appeal, the Illinois Department of Financial and Professional Regulation is essentially waiting for the court's ruling, specifically how it applies the preemption analysis in the Supreme Court case of Quintero versus Bank of America to the law. So, and as an aside, it's not clear whether or how the OCC rules or the pending litigation will fully address the issues for non-banks. So that's where we are with those two laws, or proposed rules.
Thanks, Claudia. And so I want to hand it off over to you, Becca, to ask you, how are banks, how is this impacting banks' authorities to charge non-interest fees with these new proposed preemption orders and rules?
Yep, thank you. I think what Claudia just covered, really show the combination of these rule changes that the OCC's really taken some additional bold steps. So I think it seems to be really that coordinated attempt to kind of sharpen the federal state fault lines on preemption. And what they chose in the rules they chose, I think, is interesting as well. I think just to add a note on the Illinois Interchange Fee Prohibition Act, I think that one was likely chosen by the OCC because it's a state level statute that has national consequences on our payment systems. And the IPA would have made Illinois the first state to prohibit, the interchange on taxes as gratuities, as noted. And the aim of that was to, of course, bring the swipe fees under control, given the cost, especially for small merchants today. But the impact, is looked at, I think, on a broader scale as more than a pricing tweak. It's a structural change that would have required, more system-wide recalibration of the national interchange model. So with that would come very significant, compliance and operational burdens across the payments ecosystem. So I think that was the concern, really kind of driving that interim final rule that came in kind of right before the effective date. So, I think on that side, it introduces kind of a new front on the state side of looking at payments regulation and what the impacts would be if that becomes more of a state by state strategy. So I think when you look at the net effect of all these preemption rules we're talking about, it seems to me, one, the OCC's been really trying to kind of bolster the federal legal basis to have a protective posture around non-interest fees and interchange, and really try to provide some clarity and resolve prior judicial questioning, including the second order that was parallel with the IFPA order was amending banking regulations to provide that non-interest fees come under bank authority, and that includes fees that are established by third parties, including networks. So it was kind of a twofer with coming at this one, but really an attempt to, I think, critically strengthen it. I think critics, of this approach, of course, will look at this maybe as being too broad, and I do expect there to be challenge. So that's something that has to be considered. Where is it reviving a little bit more of field preemption versus case by case as you get some of these preemption orders? I think that analysis will have to continue to be done to see if there's staying power around these orders. So I do think it's kind of teed up for judicial response at this point, potentially. So it may not be done and settled at this point. But with the stage of the law today, I think it does set the stage for litigation if it does get challenged and funneling into the court system. So I think when you think about that, along with where we're at as far as legal deference to federal agency decisions, post Chevron, that is something that could vary court by court and circuit by circuit for how they're going to look at the OCC's determinations and how that's going to play out. So it's still uncertain. It would be sort of my end comment there. The tug of war, I think, between state and federal preemption and regulation in this area is bound to continue. But definitely these preemption orders are clear signals, as Claudia mentioned, at the federal level and more of a coordinated effort around this.
Thank you, Becca. I mean, you can see what a difficult situation this puts banks in who are facing these new state laws, but also, hearing from the feds that those laws are very likely preempted. And, how do you, that's exactly the topic today, is how do you navigate that push-pull or that tension that you're sort of stuck between these two competing enforcement approaches. I want to just touch on the CFPB's FCRA interpretive rule. I was one of the founding members of the CFPB, so this is near and dear to my heart, and it shows that the CFPB is not entirely gone, because it is still in existence, at least enough to issue these types of interpretive rules. And I think, Becca, you were going to explain a little bit about what it says about FCRA preemption.
Yeah, the CFPB's interpretive rule that was issued, I believe, last October, was again, it was issued in order to supersede the prior administration's interpretive rule, which really took a narrow view of federal preemption under FCRA. The new rule is kind of a going back to, it reinstates the broad preemption model, asserting that Congress, intended for more national uniformity in credit reporting standards to avoid that state-by-state law patchwork. So the rule generally provides that all information contained in consumer reports is a preempted category. So that goes back to fairly broad language. So I think the net effect of that is, if you have state laws that are out there on the books or proposed that restrict credit reports from wholesale, including certain categories like medical debt, which we've seen, or student loan debt, those would seem to be preempted by that broader stance that we've reverted to. So I think with that, it does sort of set the stage for some clarity around maybe the categories, and I think the state's response to that remains to be seen. Do they deprioritize their attempts to regulate the content, for instance, of the credit reports, and kind of shift to other areas outside of those boundaries of FCRA? I could see if a state had a strong interest in protecting student loan borrowers, for instance, instead of trying to categorically, remove that from the FCRA content for reporting, they might focus on other types of borrower protections, would just be my guess, unrelated to credit reporting. But I think a lot of that remains to be seen.
Yeah, thank you, Becca. I think we have seen that states with the student loan debt reporting have focused on sort of, disclosures and the sort of processes around student loan credit reporting, rather than substantively removing it from the realm of debt that can be reported on a credit report, which is what they have done for the medical debt, which is why those laws are particularly, at least highlighted here as being in significant jeopardy based on this new interpretive rule. All right, well, so this is what the feds on the one side coming in with their strong preemption strategy, and then what are states doing in response? I want to turn to our next slide and talk a little bit about the true lender doctrine, which is an area where Congress explicitly gave states the authority to opt out of a national scheme. And I wanted to ask Michael to kind of give us a little bit of background here, just lay the landscape for us on the true lender doctrine.
Sure, and it's timely and exciting because we've got a big case that just within the last couple weeks was taken en banc in the 10th Circuit. That's the Industrial Bankers versus Weiser case that really touches on this area. But let's give a little history here. So National Bank Act preemption is sort of carved in the stone tablets, right? That's been around for a long time, and that gives national banks the privilege to, in one way of thinking about it, export the interest rate of their home state. They are entitled to apply those interest rates to loans made throughout the nation because they are national banks. Congress extended that treatment under DIDMCA, the Depository Institutions Deregulation Monetary Control Act, back in 1980, and allowed state chartered banks to do the same with an opt-out provision. So a state could opt out, and the language in the statute is for loans made in the state. A long time that was understood to mean loans made by that state's state chartered institutions anywhere else. Why is that important in fintech? Fintech often partners with banks to get the benefit of home state interest and that preemption ability to export a home state interest from a state like Utah or South Dakota that has a relatively high cap. Um, and so there are all sorts of true lender is about um, state authorities typically trying to characterize the fintech company, the bank's partner, as the true lender. So none of that preemptive force applies because you're not considering the bank to be the true lender. That's what the whole fight is about. What is this industrial bankers case about?
Let's
That
let's turn to the next slide because we do have some text on that.
great. Yeah, so as I mentioned earlier, the sort of paradigm was when a state opts out, it is saying, hey, its state chartered banks are limited by its interest rate cap wherever they make the loan, and then in the industrial bankers case, Colorado tried to invert that and said, we're going to opt out. And that means we're opting out of other states' state chartered banks being able to export their home state rate to borrowers in Colorado. So, in a sense, the question is, what does loans made in the state mean? Does it mean loans made by the state chartered bank in that state, or does it mean loans made to a borrower in the state? And the the district court held that Colorado's AG could not enforce this opt-out theory that Colorado could prevent other states state chartered banks from applying their home state interest rate cap on loans to borrowers in Colorado. The Interestingly, in a split panel decision, the 10th Circuit said, no, we actually think Colorado's opt-out theory is consistent with the statutory language. We think what it's done is valid here, and so Colorado actually can enforce this new opt-out theory and prevent other states' state chartered banks from applying their home state interest caps on loans made to Colorado borrowers. That's novel. It's interesting. The fact that it was a split panel means there are arguments on both sides of it that are certainly plausible. The fact that the 10th Circuit took it en banc means it's extremely interesting. And what I think we may see in another slide, there are other states who are experimenting with the same theory. So I think we are very likely to see cases percolate up to other circuits. When you get a split panel that goes en banc and leads to a circuit split, I think we all know what might be coming next. That kind of case is a strong candidate for Supreme Court review. And to me, that suggests that AGs in these other jurisdictions that have opted out or are looking at opting out are likely to be pretty aggressive in litigating the issue. And so we will likely see more activity in that area. And I think this is better than even odds of getting to the Supreme Court sometime in the next 3, 4, 5 terms.
Thanks, Mike. I mean, as you can see from our slide, you have a couple of states that historically opted out back in the 80s, but then this sort of new wave of interest in opting out from DMCA, this is actually an incomplete list of states that have introduced legislation to opt out. There are even more. They just wouldn't all fit on the slide. And so these are sort of the most recent, the ones that seem to be sort of picking up the most steam here. But I think the theme that you guys are seeing, panelists please respond to this, is that states are continuing to want to enforce their state usury laws in particular and their state UDAP laws, even in the face of efforts on the federal level to preempt some of the other consumer protection laws that they may have put into place. So let's go to our next slide and talk about how states have sought to enforce their own usury and consumer protection laws against new types of financial products and services offered by fintechs like those that are members in AFC. These are just some of the examples of the question, which is it a loan, right? A loan by any other name, right, would smell as sweet. I don't, do folks want to talk about a little bit about these examples of states seeking to enforce their interest rate caps against in these new areas? These are just some examples, but maybe folks could talk a little bit about what they think are the sort of most high priority items that they're seeing in the state AGs. And Dan, you haven't talked yet, so why don't you jump in?
Oh, man, I was hoping to make it through the entire webinar without having to speak, but you put me on the spot. I wasn't going to go into too much detail on these specific products, but I just wanted to follow up on what Michael was talking about and the conversation around True Lender and how we got here. I've worked with a number of strategic partner banks, both on the bank side and the fintech side. And over the last dozen or so years, I've really seen everything come full circle. And what we're seeing today with Wiser in the 10th Circuit feels a lot like what we saw in 2014 out of West Virginia in Cash Call, followed by the lawsuits in Colorado in 2017 against Avant and Marlette. And I think what you saw then and what you see now, again, it's a bipartisan issue. It's not necessarily a red state or a blue state issue. And as you see certain states make headway, these other states are reading the news as well, and they're following suit. And I think that's what you're seeing today with the renewed interest in DMCA. The same issue that we saw back in 2014 in West Virginia with Cash Call, which, that case always sticks out in my head because it's a classic example of bad facts making some really tough precedent for the industry to follow. You've got only 222 loans that were originated in West Virginia, but then 212 of those loans went into default and the interest rates were as high as 96%. I think the state AG at the time was a Republican. He's now the governor, if I recall. So it's good politics. It gets you votes. And we're in election year right now. So, I think there's more to come.
I'll sort of second that emotion because there is a blue state, red state dichotomy. I mean, directionally, but there are many, many exceptions, more than one would expect. I mean, we've got, if you think about pay for order flow, Florida had a big settlement recently, and New York and Massachusetts are probably the most active states in that area, and that's a strange bedfellow scenario, if you ask me.
Tell us, Mike, just for those of you who don't know, because I didn't before you told me about it, tell me a little bit about what pay for order flow is and why it's become a focus of state enforcement.
Yeah, so pay for order flow, state AGs would put it probably under the deceptive marketing. It's where crypto, but it could be securities. It's hot in the crypto space right now, but the market maker and then the crypto company make an arrangement where the seller of the crypto is getting its compensation not from the consumer. So they are able to say lowest cost sales, commission-free sales, right? But the issue is they have got an arrangement where the bid-ask spread is widened, so they make their money that way instead of by charging the consumer a percent commission. And that, in the securities context, the SEC context, that would fall under the umbrella of quote unquote best execution, right? Are you giving the best price to the securities purchaser? In the crypto space, maybe it is crypto a security regulated by the SEC? That's an open question. But the issue is there, and state AGs are onto it, and they are looking at it. And I think it's an area where we are likely to see more activity. There was big litigation involving Robinhood. I think we see some more examples of it. Letters, investigations begun looking at it for crypto issues now. So keep your eye on pay for order flow.
Thanks, Mike. I mean, out of these sort of areas of enforcement, does anybody else want to chime in on one that they think is particularly sort of an up and comer area, a product or you know, that they think is particularly ripe for state action? Maybe that's putting people to a little bit too much on the spot.
Well, let me say one, while folks think about that, I'll say one trend that isn't a substantive area, but I find a little bit interesting is actually municipalities have entered the chat, right? You've got the city of Baltimore kind of looking at earned wage access, and I would expect to see that from other um, primarily kind of blue cities, so Chicago, New York, Los Angeles, where there are, the politics line up correctly. I think we'll see more municipal actions in this space.
Yes, and I think in California, we're pretty familiar with that phenomenon because cities and counties in California have always, or for a long time, had the authority to act as mini state AGs, and we see that happen. Claudia, the DFPI also has significant authorities, enforcement authorities, right? And is that something, how do you coordinate when you've got multiple, not just the Rob Bonta's office, but also municipalities in California being a pretty big state, who are all looking at similar issues and trying to decide how to use their resources effectively?
Yeah, so what I would say, I mean, just generally big picture, DFPI California is working to fill in the gaps in regulation caused not just by a retreat in federal regulation, but also evolving product structures, right? Our goal is to help protect consumers and create a level playing field for industry. So where consumers are being harmed, we're going to focus on that, and we're going to see what, we have pretty broad authorities, as you mentioned. And so we have a dedicated enforcement team that proactively identifies and pursues those who violate the laws under our jurisdiction. And we do work closely with the California AG's office on, various enforcement matters. There's also multi-state actions that we're involved in. And in terms of municipalities, I mean, it's just a part of being communicative with your community, and having an open line of communication with your constituents and other government offices and agencies. And so just like we are open to, we have a dedicated Office of Financial Technology and Innovation where we welcome industry. We want to meet with stakeholders and consumers, learn about the products, work proactively with industry. And that's one thing that makes us a very unique regulator, in my view. We want to do the same across California because, like I said, it's a very large state. It's the fourth largest economy in the world. And so it's a big space to regulate.
And I imagine it's a little bit daunting as a regulated entity to figure out, if you are seeing an issue either through complaints or seeing other cases come up, who do you call in the state, knowing that there are these there's the DFPI, there's the AG's office, or alternatively, how do you know or have assurance that the left hand knows what the right hand is doing or thinking about, so that you're not getting competing inquiries from different government entities on the very same issue?
I mean, I think it depends on who you are, right? And what you are and what the issue is. If like I said, DFPI has, we have an open door, and we actually engage with companies. So just like we want to learn from them, we want entities to be aware of what the regulatory landscape is like, right? And so, but if it's something more, criminal nature or cyber, they may want to reach out to, law enforcement, or, we also work together with law enforcement at times. So, I mean, there's no right answer here, but it's just having open communication, being transparent, and, banks, fintechs, there might always be the question, am I regulated? Am I not regulated? Who regulates me? With all of this activity at the federal level, am I safe? Because now, there's this preemption issue. Like, I think companies just need to look at, their compliance, who their customers are, where they are, right? Geographically, if they have a big share of customers in California or another state, they can't just hide behind the fact that they are headquartered in, Montana or wherever it may be. So just taking a really hard look at, compliance and who the customers are and whether the products are harming customers or not.
So
I can weigh in from my perspective just a little bit, at least in terms of what I see as an operator. More and more, at least in more than a couple of states, we're seeing increased coordination between the state AG's office and the state banking financial services regulator. And that has become more BAU, where I think maybe in the past, that may have raised your antenna a little bit more. I think as of recently, we're starting to see that just become part of the norm in terms of how the AGs and the state regulators, the banking agencies are working in tandem.
Thanks, Dan. And actually, I wanted to move to the next slide because I think, speaking of working in tandem, one of the most significant things that we see are these multi-state actions, and one of the most significant ones that we've seen in recent years is the People v. OneMain Financial. Do you think that what lessons can we learn from this case in particular, and what do you think this says for companies that are operating nationally, and maybe targets for this kind of enforcement, nationwide, essentially enforcement action?
Yeah, I mean, I think it's a great question. And again, it's just really putting the focus on the fact that the state AGs are not going anywhere. They all have their own state UDAP laws that they're going to use if they see some form of business conduct that they don't agree with. And again, it's a bipartisan issue from a practical perspective. Talk about the OneMain Financial case. This is a classic credit insurance add-on product type of case rooted in theories of UDAP and state usury laws. And so again, I think it's just a reminder that just because the federal government may be taking a different approach, the state AGs, whether it's a red state or a blue state, it's good politics for them to go after bad actors. And I think the OneMain Financial case is a good example of that, and it's pretty clear that at least in OneMain's defense, they've been pointing to the 2023 CFPB consent order with millions of dollars in penalties and redress. And they're arguing that the states are relitigating these issues and the states don't care.
This reminds me, because they brought CFPA actions in One Main Financial, that before Rohit left the CFPB, they issued a particular, like a white paper, basically on how states could strengthen their consumer financial protection laws and enforcement. This seems to be taking a page right out of that playbook. Would you agree with that?
Yeah, no, I think that's right. And again, as a practical matter, I think folks in the industry, certainly folks in my role, can really look to a lot of those data points to inform the strategy and make sure that we've got the right legal approach to mitigate risk, especially as we're looking to launch new products, new partnerships, and new features through uh, marketplace lending partnerships and the like.
In terms of these, let's talk a little bit about state legislation for a minute. Can we move to the next slide?
Well, before we do that, Meredith, I
Yeah.
also wanted to point out that, and I know it didn't make the slide, but you're also seeing activity in solar finance enforcement. The Texas AG, who is also running for senator, Ken Paxton, um, he's launched an enforcement initiative targeting the solar industry. And again, the focus is on UDAP, overstating savings claims, misleading disclosures. So again, just classic UDAP issues that um, are really good politics, no matter if you're a Republican or a Democrat.
Thank you, Dan, because I was getting ahead of myself and even getting ahead of my slide here, which is about other state enforcement priorities. We talked a little bit about the usury and the lending laws, and the sort of traditional, kind of straight down the middle UDAP claims that are still very much a focus of state enforcement actions. But then we have these other areas like debanking, which don't necessarily fall along the traditional kind of red state, blue state lines, or they may. Does anyone want to talk about some of, we already talked about pay for order flow, but what about states that are looking at debanking? What about the impact of the CFPB's guidance on disparate impact analysis and algorithmic pricing?
Well, I'll talk a little bit about debanking. I think it puts banks and fintech the partnerships in an interesting position because the feds want to sort of de-emphasize reputational risk and are sort of saber rattling a little bit about potential consequences if the wrong clientele is being debanked or declined for service in a fintech bank partnership. On the other hand, there are legitimate reasons, like business reasons and safety and soundness reasons, to be selective about one's customers. And so, how to balance that is difficult just from the company Fed perspective. When you get into state AGs who may have different views about who could legitimately be debanked and who should be protected from debanking, um, it's a real minefield, and we're just at the front end of it. We've seen a couple, obviously Trump had his case and that went where it went. But on the enforcement side, I think we're still working out exactly how it's going to play. And so I'm expecting to see people finding themselves in some uncomfortable decisions and having to kind of choose trying to balance, I guess is the way to put it, the three goals of your business priorities, your federal regulatory priorities, and your state regulatory priorities.
That's a really good point, Mike. Does anybody else want to jump in here on our state and other state enforcement priorities before we shift into new laws that can be enforced by the states?
I can make just a quick note on disparate impact. Even with the change, which feels like a federal shift away from disparate impact, I think there's still other avenues where that type of bias claim still comes into play under various other both federal and state statutes. And the states, we talked about, can bring federal claims under the CFPA, and that can be UDAP claims broadly under the federal statute, which would be one avenue, but also the state UDAP claims under their own state statute can bring in claims such as disparate impact. But then I think, we're also watching and seeing the state-specific AI statutes that are cropping up, such as Colorado. And although Colorado is now being kind of pared back a bit, these laws are continuing to be introduced and will be another area where I think disparate impact remains relevant.
Thank you, Becca. I think that's a really good point. Dan, did you want to chime in?
Yeah, I just the point that you made and Becca made around disparate impact, I think really just reinforces the idea that none of this is new. The CFPB back in 2022 expanded UDAP to cover disparate impact. So to the point that you were making earlier, Meredith, I think the playbook is there, and you're seeing state AGs pick that up and they're running with it.
Yeah, I mean, I've seen a lot of my former colleagues from the CFPB who have left go into state AG's offices. So I have to think that they are bringing the knowledge, the expertise, and the priorities that they had when they were at the CFPB into those state offices.
Yeah.
Let's talk a little bit. This is our last slide, and then I'll give you guys your code so you can get your credit. To just stay tuned. Don't worry, just only 5 more minutes so you get your code. I think this is a really good segue into talking about state legislation. In particular, I mean, I have 2 examples here from either coast, so that we're being bi-coastal here. Sorry, Becca, because I know you're in Minnesota, so skipping over what is a lot of interesting activity there too. But for the FAIR Act, Mike, I wanted to ask you to talk a little bit about the new powers and authorities that New York has enacted, given it to itself and also to private individuals under New York's FAIR Act, which just became effective earlier this year.
Right. So in a nutshell, what the FAIR Act does, and it's interesting, the title includes the FAIR is fostering affordability and responsible business practices or something. So it's all about affordability, which is, a huge buzzword that we could probably spend a whole hour on. But effectively what they've done is is outlaw unfair and abusive practices in what had previously been a Deceptive Practices Act. So an intent to expand there using terminology that is common at the federal level and among other states, unfair and abusive, but has historically been thought of as vague and quite elastic. And perhaps that's why New York adopted it. Maybe they were intending to engraft other states' interpretations of what those terms mean, but I think generally speaking, it must be an expansion of the scope of the statute because they've added words through a legislative enactment, and that takes effort and work. One of the most interesting parts of it is that private actions, so civil litigation by private plaintiffs, can enforce the deceptive practices arm, but authority to enforce the unfair and abusive prongs rests in the Office of the Attorney General. So with these new tools in the toolkit, I think we will see the New York AG's office work hard to bring actions to help define the scope of those claims, and their interest would be of those terms, and their interest would be in defining them broadly. So when we think about all the subject areas of fintech that we were looking at, I think actions under the FAIR Act are reasonably likely to begin flowing in the next 1 to 3 years. There are some other interesting things going on in New York that aren't on the slide. I'll just highlight that they recently enacted, I believe, the Algorithmic Pricing Disclosure Act. So algorithmic pricing is a hot topic. The AI that Becca was talking about is important, and that's a disclosure law, but whether it suggests that private actions for uh, disparate impact fostered through algorithmic pricing, or we've even seen litigation in the mortgage lending space making an antitrust claim about algorithmic pricing, that because the information that drives the algorithm comes from competitors and then gets aggregated, and then those same competitors are getting suggestions about how to price the product, that might be anti-competitive conduct. So algorithmic pricing is a huge area where I expect a lot more activity, and we see that in some of the legislation that's come out recently.
I did promise that I would give people the CLE code, so I want to do that now. That's 41984. And Denise, I don't think I have the ability to post that to the full chat. So if you could add it, again, it's 41984. We also, and if there are questions, I want to make sure that there's time for people to ask those as well. Again, I'm not sure that I control that, but Denise, you'll let me know if folks have questions. I did sort of skip over Claudia's last point there, which was on California's digital financial assets law. How is this law different than simply regulating digital assets through the money transmitter licenses that have been, sort of the standard mechanism for doing that?
Yeah, so the Digital Financial Assets Law, or DFAL, has the benefit of regulating crypto businesses and not just trying to use existing frameworks to do so. There's a lot of similarities. So just like with other businesses types we regulate, we review financials, executives, business plan, and risk for the businesses. But for digital asset businesses, we especially care about cybersecurity and anti-fraud. So think about like money transmission license is fundamentally about the movement of value, regulates the act of transmitting funds, holding customer funds in transit, et cetera. And actually many states have adopted money transmission law frameworks to cover digital asset businesses. DFAL is structured differently. So it's a purpose-built licensing regime for digital asset businesses that reaches activities that money transmission frameworks typically would not cover. And just one thing to note, and I know you didn't ask this question, but it's important to note that, so the law, it was signed by the governor in October 2023. There's a kiosk aspect of it, which already is being implemented. And in fact, in June of last year, DFPI issued its first consent order against an entity, CoinMe, an entity operating crypto kiosks. But for companies that would fall under the law, if they want to keep operating in California, they have to apply for a license by July 1st. So they don't have to get the license. The portal's open, so people can apply through NMLS. And as long as they have their application in by July 1st, they can continue operating as the application is under review.
Thank you, Claudia. So final thoughts from everyone. I'm just going to say mine first, which is, this last bullet point on the New York Fair Act, the treble damages for knowing violation and attorney's fees. When there's blood in the water, the sharks start circling, right? And you know that if there's a state enforcement action or a class action, the other one is likely to follow. So it's not, that's that's not rocket science, but I think there, clearly the New York legislature is essentially waving that flag at folks that, hey, you can do this and you can make it pay to plaintiffs' attorneys. But Becca, I'll start with you. Final thoughts before we sign off. Have we scared everybody sufficiently?
Well, I'll just take a note too, when we talk about states flexing their muscles, these are a couple examples, but there's so many other examples that are out there right now, I think, at the state levels. And another one just to be cognizant of and be looking at is the continued evolution of the anti-evasion statutes that will impact marketplace and consumer lending programs. I think we're seeing that move from sort of the court decisions of the Colorado case we talked about into codification, into the statutory frameworks and sticking there. And so states like New Mexico, Connecticut, Minnesota have done that, or proposed laws such as those. And then I think some of the backdoor kind of enforcement comes with state licensing as well. So as those licensing statutes expand, you kind of see more avenues and tools, supervisory tools at the state level as well. So I think a lot of different statutory hooks that come into play and to be aware of, and it's kind of mapping, like almost a heat map, I think, of all that's going on the state level, which is so incredibly active.
Thanks, Becca. Dan, do you have final thoughts?
Yeah, I think if anything, I would just recommend continuing to emphasize best practices when it comes to regulatory compliance. Need to follow the enforcement trends. That's going to better inform your business strategy and really help the control function look around corners so that the business doesn't have to worry about speed bumps down the road. I think the other takeaway I would suggest is continue to engage counsel early, especially the folks like we have on this call that are in it every day. It's just so invaluable to get that insight from folks that have that deep level of experience. And then lastly, make sure you've got really strong change management controls. It's what's new is old, what's old is new. It's basic marketing, substantiation, UDAP types of issues that you need to get out ahead of. And then, of course, monitoring consumer complaints. All these actions that we've talked about, West Virginia, Colorado, the solar cases, One Main Financial, but all driven by consumer complaints. A lot of people have different hobbies like golf or spending time with their children. I like to think about complaints because they truly are the canary in the coal mine. And I don't know how else to do this job than to, really listen to what you're hearing from those end users, because that's exactly what the regulators are doing at the federal and the state level.
When I was at the CFPB, we used to call it sentinel diving because we just dived into Consumer Sentinel to figure out what people were complaining about. Mike and Claudia, we're at 12, but I don't want to leave you without your final word. So, Mike, why don't you go first, and then Claudia will give the state regulator in the room the final word.
Oh, so many interesting things. Thanks to all the co-panelists. This was informative for me. I loved it. I think everyone should be cognizant of those trends we talked about, and including pushing down regulatory authority and enforcement authority to municipalities, because they can be a little bit more unpredictable in what they're going to dive into and how deep they're going to dive into it. And then also those multi-state coalitions, I think we have to watch. They're very powerful. They take a long time to wind up. And so when you get that many people collaborating on something, it's probably going to be a sustained effort. So watch those and be attentive to what they're focused on.
Claudia, last word.
Thank you, Meredith, for giving me the final word. I will not end on practical advice like Dan did. I will end on the more philosophical observations of where we are now and generally the period of deregulation that we're living through right now. Economic development and innovation are great ways to measure success, But there is a misconception that regulatory rollbacks are good for growth. Tech advance, I mean, thinking about California and tech, it's a positive thing, right? And state regulators need to get regulation right, and that's part of what we do at DFPI. Try to do that. But general like federal retreat of regulation is never good. I mean, we've seen this throughout history, various times. Some periods of hyper deregulation can be lucrative for some actors, but it doesn't end well for most. So I'll stop on that note.
Thank you, Claudia. And thank you everyone for joining us today. We really appreciated it. If you have any follow-up questions, our contact information is readily available on our websites, and we're here to support you as you navigate this, old and new landscape, right? What is old is new again. So thank you all and have a great rest of your day.